Hello, my name is Alan Pierce, and I'm with Heritage Bank of the South. I'm doing this short video to try to give my explanation of where I think rates will go this year. I think we're okay for 2012. Rates may even get a little bit lower. I think it's going to be really hard. So bear with me. I'll give you my thoughts through the following graphs and charts. The first one here is a bond chart, the Fannie Mae 3.5% coupon, and I go all the way back to October of 2010, and I do this only to make a point. In October of 2010, the Fannie Mae 3.5 bond hit 102 level, and then by December the 16th, 2 months later, 60 days, we were at a 92.69 level. Now, I'm not trying to make a bond trader out of you, but what I am trying to show you is this graph. When bonds are up, rates are low. When bonds are down, rates are high. But what this represents is a 9 discount point move in 60 days. So that's the equivalent of, right now we got 3.25 on a 15-year fixed. This 9-point move right here would really mean 6% on 15-year fixed. 30-year fixed would go from 3 7/8 to 6.5, and it's not like it can't happen. It did. It happened less than a year and a half ago. Okay, and we went all the way over here to today, or on 17 January, we had a price of 103, and I got the next chart down that goes to me that explains the 103 a little better. This is a 3-month chart of the same 3.5% bond. Now, we started out over here 3 months ago, October 18, at 101, and we went all the way up here to 103, slightly over that. We've come back a little bit, but why did we go from 101 to 103? It wasn't Fed buying mortgage-backed securities. It wasn't intervention or any of that. It was Europe. Okay, Europe's falling apart, Chicken Little in the sky's falling, and everybody runs to our bonds. The 10-year T-bill went below 2%, and it was slightly over 2% to 2.85. The next chart is again indicative of what have been talking about. I'm trying to get the point across. Is this is the 10-year T-bill, and S&P downgraded our debt right here in 2011. But look what it did. I mean, our debt went from slightly over 2.5% on the 10-year T-bill to, below 2.5% and even below 2%. Again, why? And it's the European problem. And right now it's kind of in a recess or halftime, if you will, but it hadn't gone away and it hadn't gotten fixed. And I wanted to show you this chart simply to show you what the blue line is Italy, yellow is France, red is Spain. This is what Spain is paying for their 10-year T-bill, almost 6%. This is what Italy is paying, almost 6.5%. France is in a little better shape, but they're at almost 4.5%. All right, the point that I'm trying to make here is everybody's rushing to America because we're safer bet than the European countries. But this chart is a 12-month Federal Reserve receipts to outlays. So this is what we're bringing in, the blue line. Okay, this is what we're spending. And you see the divergence here in 2007 in order to avert the catastrophes, and nobody will ever know what would have happened if we had not spent all this money. But what everybody does need to know is that we borrowed 38 cents on every dollar that the U.S. spent over the last 3 years. And what that's done is added $4 trillion to the U.S. national debt. Now, how far away are we, if we continue on this path, than the European countries that we just looked at? this is one of the few positive signs that I've seen that I believe for housing. And this graph shows house prices relative to median income. So if you see this 3% line, we stayed below 3% until about 2001 or 2. And then it just jumped like a chicken, went up over 3.8, and all things that go up come down. Most things that go down come up, but we are now at really historic lows for homeowners' median income as a percentage of home prices. And to me, this is a very good sign. It means people that are getting loans now, they can afford the homes, they will make their payments. We won't see the problems that we've seen in the past. This is, to me, another big problem that we have is, this is back in 81, happened to be the time I got out of college. Interest rates were 21%. Okay, so the Federal Reserve had a lot of room to cut rates and make the economy better. Now we got the same problem at 8.5% unemployment, if you believe the government numbers, but Fed funds are at 1/4%. Back here they were at 20%. We had a lot of ammunition to make the economy better. Right here they're at 1/4%. So how are they going to improve the economy, the unemployment? How are they going to stimulate the economy? We cannot keep spending money the way we've been spending money, and there's no room left to cut rates. Now, this really would be funny if it weren't true, but this is about how much paperwork you're going to have to do now if we do a mortgage. It's not easy, but it can be done. We're not under documenting loans now, we're over documenting loans. But honest to God truth, Congress has recently passed a 1/2 point fee that will be added to every mortgage that Fannie and Freddie does to help to pay for the payroll tax cut fee. So there are no free lunches. Why the Federal Reserve and the Treasury would spend billions of dollars buying mortgage-backed securities to get rates lower to make homes more affordable when we have record homes in distress and shadow inventories at banks with troubled properties that are off balance sheet and nobody knows about. Why would we pass a law or pass a bill to start making it 1/2 point more expensive to get a mortgage as of April? If you can call and tell me, then we'll both know. I'll be doing this newsletter each week. I'll give you my opinion on where rates are going. I think short term we're okay, but I think by the middle of 2012 possibly, rates will have no choice but to start going up. It's an election year. I know you've been hearing this since 2007. The rates will never go any lower than this, and who knows? But I think the problems in Europe are going to run over here, but they're going to help us before they do. But make no mistake about it, everybody's going to feel this pain before it's all over with, and we're going to feel it from head to toe because there are no free lunches. This is a perfect example. You get a payroll tax cut over here, but you get a mortgage fee added over there. I hope this has been somewhat informative. I appreciate you giving me your time. You have a great week. If I can help in any way, give me a call. My cell phone number is 404-805-5230. 404-805-5230. Thank you very much.